All right, let's talk about China, and we'll get through China pretty quickly because the reality is that the China story is one of a challenging story for them. They've had historically for a couple of decades their really consistent economic growth. And so looking at their GDP numbers, we saw the economy grew by a seasonally adjusted 1% in quarter four of 2023, matching market expectations, but moderating from an upwardly revised 1.5% increase in Q3. Now, it was the sixth consecutive period of quarterly expansion, and weakness in the property sector continued to drag on the broader economic recovery. And we'll talk a little bit about Evergrande soon. And at this time, the government is reluctant to deliver major stimulus packages due to attempts of controlling mounting government debt. So, story isn't great there, Evan, is it?
No, and that's that's the core conclusion out of it at the moment, is that Beijing is trying to weigh up the policies it's done for the last 40 years versus the new economic reality that it's now facing. It's a mature economy. I mean, it's trying to tell you it's not, but it's a maturing economy. Its middle class is now absolutely, the core to it domestically. It is moving towards all of those changes that you see in a maturing economy. And so it can't keep expanding at 6%. It just can't. Although back in the day, it told you that it had to expand at 6% per annum to maintain full employment and all those kinds of things. It just can't. And then, you do, when you get through that expansion phase into that sort of mature phase, you do get a story like Evergrande and a few others, and we'll come to that in a minute. So for me, I actually think GDP moderating the way it is, that's the first time the Beijing's actually said that their GDP expectation for a year is going to have a 4 year-on-year in front of it. Now, it is still high. It's 4.8 to 4.9%, but you would never have forecasted China saying that 4% growth or high 4% growth is something that they're aiming for. Because, again, the charts that we've shown you and what you can hear in terms of what Ben's saying is that the moderation is happening faster than they were expecting. It's, again, the mode that they've got around that issue of stimulating, building, infrastructure and infrastructure projects that, the road to nowhere is the story we all know about, is starting to actually move away. They're now actually consolidating themselves, moving into domestic GDP focus, moving into consumption GDP focus, and that will be China's story going forward. It's going to be interesting for us here as well, because that means that they are going to shift away from our exports, and we're not going to have that inverted commas white knight that China was with regards to grabbing our rare earths out of the ground, whether that be copper, whether that be iron ore, etc. They'll still be our major trading partner, but it just will be in a different way.
Let's look at the inflation story there, and it's a bit of a non-story, right? I mean, we look at the last 3 quarters, negative 0.2, negative 0.5, and obviously we saw prices fell by 0.3 year-on-year in December, marking that third straight month of declines, which is the longest streak of drops since October of 2009. So their story is not so much inflation, but it's disinflationary, or that's the risk here. Now, when we obviously need to look at this from an Australian lens as well.
Mm-hmm.
This is obviously meaning that exports for them, which are imports for us, there's a lot more competition for that. So we would expect that we will be importing lower cost of goods in those particular markets, so especially clothing, where there's competition in those particular areas. So, and obviously the dollar for us has gone up a fair bit since November and December of last year. So some of that importing costs, we also should be importing lower or disinflationary results in that sort of clothing manufacturing area of what we bring in from China. Any thoughts on their inflation story, Evan?
No, so because we need to keep moving very quickly. The only thing to tell you is that this is actually a fallout from COVID as well. So you talked about that competition. The increase of Vietnam, the increase of India, and the increase of other parts of Southeast Asia on their core exports is showing up in this data. They're having to compete. They haven't had to compete before. They're having to actually cut price to get it in here. And that is what is also interesting, because it's not just exports they're having to do it, it's on the import side as well. All of a sudden, their domestic productivity versus a Vietnam versus an India is not as strong as it was, because they're actually higher labor costs and they're higher costs in general. So that is the other shape that's going to be going with China. Watch that story. It's a decade story, but it's coming already. And Australia is already starting to prepare for it, that we are flexing our view to other parts of that region as they become more competitive than what we've been used to, which is China.
All right, so let me just summarise their interest rates. They again kept everything pretty much as normal. So the 1-year prime rate, the LPR, which is the medium-term lending facility used by corporates and household loans, was kept unchanged at a record low of 3.45% for the fifth consecutive month. And then the 5-year rate, which is a reference really to the mortgage rates, was held at 4.2% for the seventh straight month. So really nothing to see there. In terms of their employment story or the unemployment story, we saw in the data that the surveyed urban unemployment rate inched up to 5.1% in December, and that's from a reading of 5%, previously for the last 3 months. So the unemployment rate for the population aged between 16 to 24 fell to 14.9% using a new model compared to the record peak of 21.3% in June after the release of the data had been suspended since July. So whether we can trust those numbers or not is a big question. I think Evan's sort of giving us that clue there.
No. And I think it needs to be pointed out very clearly that at the moment, the unemployment data and where it sits needs to be not just taken with a pinch of salt. It's a big handful, throw over your shoulder sort of stuff. I know that's a bit facetious, but the reason it's can't be trusted is that, again, there is that blurring of economics into politics, and you have to be open to that. You have to be open to that's how China works, and we know that. So it means, therefore, they're also starting to see more young people, look outside of China, so moving to places like Australia, but also taking up second and third university degrees to get around it. So I take their employment data with, as I said, a handful of salt at the moment rather than a pinch.
No worries. Well, let's now talk about then the consumer sentiment on the back of that. I mean, if China is going to have a prosperity medium to longer term, it has to happen internally. It can't necessarily be on the back of their export story. So what do we see in terms of the consumer sentiment? Consumer confidence in China decreased to a reading of 87 points in November. So this is still pretty lag data, but that's down from almost 88 points in October. So we're seeing the consumer's not buying the Chinese economic story at the moment. So, and consumer confidence in China averaged 110.1 points from 1991 until 2023, reaching an all-time high of 127 points in February of 2021, and then a record low of 85 points in November of 2022. So the consumer over there is really struggling to find, any sort of confidence in the story. And I think that also plays out if we move quickly into the retail sales. We can see that the month-on-month retail sales in China increased only by 0.42 of 1% in December over the previous month. Retail sales month-on-month in China averaged 0.75% from 2011 until 2023, reaching an all-time high of 4.98% in May of 2020, and a record low of negative 10.77% in January of 2020, just as COVID was starting to rise up. So that sort of summarises that. I don't probably need a comment on that. What we wanted to talk about just quickly is the Evergrande story, and then we can wrap up China and move on to the Eurozone.
So with Evergrande, this has been dragging on for about 2.5 years. And if you didn't see, what happened at the last week of January was that the High Court of Hong Kong has had enough. And it is that term because they had managed to get 3 major adjournments over the last sort of year and a half. The fourth one they were applying to, they rejected it. And the High Court said, enough is enough. You are having to liquidate. And why it's so fascinating for the Evergrande story is that we'd seen since this really came about, Evergrande at one point had debt that was largest in the world. They had about 550 billion US dollars of net debt across their business. And they've been working that down, which has been good, but they're now at a point where they can't find credit. They just cannot find creditors. They cannot actually get people to underwrite their story. And Hong Kong has said, you now need to liquidate your overall holdings completely. Why I highlight it is that mainland China was always going to be the question. Does Beijing listen to this? And so far, the signs are they are. That's what's so fascinating about this, is that they are going to abide by the ruling out of Hong Kong. They are going to liquidate Evergrande. That, therefore, spreads out into the overall story around, the construction industry in China, the property construction industry in China. that the debt-laden scenario of it now probably is had its panacea. We're at the peak, and we're now at the back end. Again, as I said before, when you have a growing economy like China has been over the last 4 decades, it does get to a point of, actually maturing, and we're there. And Evergrande, in my view, is that story. It doesn't mean that the China story burst. That's not what I'm saying at all. It just shows that those that have been overly indebted or overly, orientated to one sort of trajectory, which is probably the way to say it to you, is probably now coming to an end. And Evergrande will be, in my view, it's not like a Lehman's. That's not a great comparison. It is like what you've seen in the past, where you get those mature stories. Poseidon's another one as well. They are all now coming to a China story as well. So 2024, Evergrande won't be the end of it. I think it'll be signs of that happening. It just means, again, as Ben's highlighted, retail sales will be under pressure because of it. Unemployment will be slightly higher because of it. The Chinese story and the Chinese growth story will not be the same as what it has been over the last 4 decades because it's maturing.
Yeah, look, and we know off the back of the property boom that had over the last 2 decades, that is also a positive for the wealth effect and everything that goes on there. So,
Correct.
yeah, China's basically got their back against the wall, and the government needs to continue to sort of monitor that in terms of how they take that forward. Speaking of economies that are obviously in challenge and picking up from my last update in December of last year,